Hello everyone, this is a short video on dividend policies. Now, what exactly is dividend policies? Basically, a company who has been in business can either choose to pay a constant dividend. This could be a constant percentage. So it could be 10% financial year, every financial year. Or it could be a constant amount. Say some companies who have been in business again for several years could be paying maybe 5 million every year. In any case, if some companies do not want to pay dividend or choose not to pay dividend, they also can have a share repurchase or share buyback option. But we will come to that later. Let's look at why is dividend important? Well, dividends is important for two major reasons. One is the signaling effect, and one is the clientele effect. Now, what exactly is the signaling effect? So let's take this company here. Let's assume this company is paying a constant dividend of 10% every year. And for some reason, and we'll come to the reasons, it decides to pay for this current financial year 5% dividend. Now, what does this signals to the market? And what does this signals to the shareholders? Well, why has the company changed its dividend policy from 10% to 5%? Is it because the company is experiencing a fall in earnings? Could be. In which case, well, it is really sending a bad signal to the market? Or could this company be experiencing a fall this time in cash flows? And again, this would be sending a very bad signal to the market. This is why some companies, although they may be experiencing fall in earnings or fall in cash flows, they will still stick to the 10% dividend every year because they don't want to send the wrong signal to the market. Now, this could be a good thing or this could be a bad thing. Because really, if you're having troubles in this company, and as a shareholder you would not know unless you dig in and really analyze the company, and the company continues to pay 10% every year, well, sooner or later, this company is going to hit a tipping point. Let's just hope this does not happen. My point is this: there is a signaling effect to the market. Now, there has been many researchers who have been affected on companies listed on various stock markets, and it has been found that about 70% like to stick to their dividend payment. Let's come to the clientele effect. When shareholders invest in a company, well, the shareholders may be coming from different age groups. Some age groups like to take risks, and they want to buy the share at one point and maybe sell it at some point. And if they do, they would make a capital gains. And normally when you make capital gains, well, you pay capital gains tax. Or some category of investors, and I'm not judging here, but I'm guessing um, shareholders maybe over 60 or in retirement, they would normally want some form of regular income in the form of dividend. And when you have dividend, you normally pay income tax on your dividend income. And I know that in most jurisdictions, capital gains tax normally are lower than income tax. So it really depends on the tax bracket of where the individual falls. Maybe someone who is a high earner maybe wants to invest and make a capital gains because he or she does not want to pay higher taxes. I mean, it depends on the bracket where the shareholders falls in. But I hope you see where I'm going with this. There are normally two reasons why shareholders would want a dividend, or there are two effects. Now, a company may also choose to have share repurchase, in which case, at some point, they want to buy back the shares from its shareholders. And if that's the case, then the shareholders will make a capital gains and pay capital gains tax. It depends on the company policy, and it depends on what exactly the shareholders want. The key dates when it comes to dividend policies is illustrated here. So you normally have a board meeting. Following the board meeting, the directors will decide on the amount of dividend that will be paid. And if the company is listed on the stock exchange, there will be a public announcement. So they will declare the dividend. But of course, once they declare the dividend, they won't pay the dividend until some future date. So, which is why you'll see here, this is the payable date. Now, what happens? They have to communicate with the stock exchange where the company shares are listed, and the stock exchange will establish something known as an ex-dividend date. An ex-dividend, it comes from the word exclusive of dividend, which is why we call it ex-dividend date here. It simply means at this date or up until this date, any exchange that happens in that company's shares. So if I buy the share before the ex-dividend date, well, then I will be entitled to the dividend. And if I'm buying the share after that ex-div date, so somewhere around here, then surely, sorry, I would not be entitled to the dividend. Finally, two ratios that you need to consider um, before you make any investment in a company. One is dividend payout ratio, and the ratio goes dividends over net income. Why dividends over net income? Because a company will normally pay dividend only if it's making a reasonable profit. So let's assume, and I'm making this up, that a company is paying, so $100 of dividend, and the income is 1,500. That means the company would be paying, or the dividend payout will be 6.67%. And surely, if you're an investor who likes dividends, you would opt for a company where the dividend payout ratio is rather high. Finally, dividend yield. Well, dividend yield is whatever dividends that has been paid. Let's say a company pays a dividend of, let's say, 20 pence, and the share price is, let's say, 250 pence. So that will give you, in percentage terms, a yield of 8%. Now, how is this important? Imagine if you had to make a decision as to whether you want to invest your money in a bank account, which pays 4%, or investing your money in a company where the dividend yield, the bank account which pays 4%, I might have said 8, or in a company that pays a dividend or that has a dividend yield of 8%, then surely your decision would rather go for the company, especially if the company is a strong one. So there you go. This is a short video on dividend policy.